invest in real estate. So what I'm going to do right now is I'm going to give you my top 5 reasons to invest in real estate. Now there's several more, but these I think are the main reasons why personally I got involved and why I suggest you get involved or learn more about real estate investing or become better in real estate investing than you already are. So let's dive into it right now, starting with number 1. My top reason for investing in real estate is a hedge against inflation. Now, for those of you who don't really know how inflation works, then you definitely need to start watching the videos that I have on Monday, Wednesday, Fridays, where I go over how macroeconomics affects the real estate market and real estate investing more specifically. But inflation is the rate at which the prices of goods and services increase. So that is the layman's version, and that's the version that everyone understands. Technically, based on the definition given by the Austrian School of Economics, it's any growth in money supply is considered inflation, and a decrease in the money supply is defined as deflation. But let's just go with the one that everyone understands, and that's just basically prices going up. That is inflation. So you've heard, or maybe you've heard, that since the Federal Reserve was implemented in 1913, the US dollar has lost 95% of its value, or 95% of its purchasing power. So you think, well, that sounds crazy. That doesn't seem right. Well, let's think about it this way. Let's go back to 1913, or think about that. And remember, you've heard all the stories that what you could buy for a nickel. You could buy a gallon of gas. You could buy lunch at McDonald's or something. McDonald's, obviously not invented in 1913, but you get my drift. You could have bought a lot for $1 back then, a lot more than you can now. Now $1 is really not worth much, especially a nickel or a dime. Most people, if they found or saw a nickel or a dime laying in the street, they'd barely take the effort of going to pick it up. And that was not the case in 1913. And if you want something more precise, I would go on to Google and I would search for an inflation rate calculator or an inflation calculator and just type in $10 in 1913 and then just type in 2019 and see how much money you would have to have in 2019 to buy the same amount of goods and services that you could have purchased in 1913 with $10. And for most people, your jaw will hit the ground because of the amount of inflation that we've had. And most people even alive today, especially younger people, have never really experienced inflation. They've only experienced what the Federal Reserve would categorize as price stability, which I would still consider inflationary because it's targeting an inflation rate of 2%, which compounded over time makes a big difference. I consider price stability at 0 inflation, but that's another video. But most of these millennials and younger people, they've only experienced just kind of a steady rise in inflation. They don't know anything about the 1970s. They don't know really anything about the 60s or the 40s when we had much higher inflation. And especially in the 70s, it was extremely problematic to the extent that we meaning the federal government, had to issue what they call Carter bonds, which were U.S. debt denominated in Swiss francs. Why? Because no one wanted any asset denominated in U.S. dollars. So inflation can get really nasty. Those prices going up. A more real example would be if you would have had that $10 that we were talking about earlier in your bank account. Let's say that $10 back then could have bought you a down payment on a house. Or let's put it this way, $1,000. Let's say $1,000 in 1913 could have bought you a house. Okay. Well, if you would have just kept that money in the bank, even compounding for the interest you'd get in the bank, you still wouldn't have near as much purchasing power today as you would have had back then, because inflation continues to erode at the purchasing power of cash. That's really the bottom line. But with real estate, not so. If we looked at a chart going all the way back to 1900, and it's one of my favorite charts, and you look at real estate or home prices in the United States adjusted for inflation, you will see that even throughout the 70s, even throughout the all the times of high inflation, the 40s, the 60s, here in the United States, you would not have lost any purchasing power by having your money in real estate. And we always hear about gold being a good hedge against inflation, which it is in most times, but it's really got two problems with it. Not that I don't suggest buying gold. I definitely suggest having a small percentage of your portfolio in gold, but it doesn't pay you anything to own it. In fact, the opposite. You have to pay to own gold. It's got carrying costs. You have to pay to have it storage, or you have to pay to have it stored. There's a lot, not a lot, but there are some carrying costs that are involved with gold, where with real estate, if you buy the right real estate, it's the opposite. You are going to be paid to own that. So the takeaway is real estate is the best inflation hedge that I can think of. And that goes for the United States, that goes for South America, that goes for Europe. It is historically proven to be the best inflation hedge that there is. Moving on. Number 2. Real estate allows you to use leverage in your portfolio or in your investments. So what this means is you can control an asset that may be worth, let's say, $100,000 for only a $20,000 down payment. So for $20,000 out of pocket, you can have the appreciation of a $100,000 asset. So let's say that asset goes up by 10%. Okay, well, it went from $100,000 to $110,000. The asset itself went up by 10%, but your ROI went up by 50% because you only have 20% down or 20% out of pocket to purchase that property. So you only have $20,000 of equity in it, but you made a $10,000 gain. So that's one of the ways that using leverage can really be a benefit to purchasing real estate or holding that in your portfolio. Now, of course, that can work the other way. If the value of the asset goes down, or the price, I should say, of the asset goes down, it will have a greater effect on the amount of equity that you have in terms of percentage. But if you're just buying a good old-fashioned rental property, if the price goes down by 10%, by 20%, who cares? As long as you are collecting that cash flow every single month, as long as it's cash flow positive, and as long as you buy right, you've got the right remodel, you've got the right house, the right neighborhood, the right school district, so you've always got demand for renters there. Hopefully you're buying under the cost of construction, which I always suggest. You're going to have very limited downside. And if you are buying the asset up front, strictly doing the numbers on cash flow, as long as that cash flow doesn't change, what does it matter what the price does? The price could go down by 50%, it could go up by 50%. It really doesn't matter because you're still collecting that rent check every single month. And that rent check is just going up with inflation, just like the value of the asset should over time. So, number 1 is inflation hedge. Number 2 is the use of leverage. Let's move on to number 3. And that's that you can get a higher yield. Whenever you're investing, you always have to ask yourself, compared to what? So, is gold a good investment? Well, compared to what? Are bonds a good investment? Compared to what? So, with real estate right now, we have to look at the return or the cash flow, the yield that we can get on that initial investment. So let's just say that you can get an 8% yield, which I think is very doable with real estate right now, going into linear markets that I like in the Midwest and the South that don't go up much, that don't go down much. So you've got limited downside, buying under the cost of construction, all those things that I talk about. I think you could get, even on a turnkey property, one that you're not going in and buying low and rehabbing, I think you could get an 8% return. So compared to what? Well, let's compare that to bonds. Well, the long-term bond right now, or the 30-year, I don't have a chart pulled up in front of me, but I would guess that that's yielding somewhere around 3%, if that. And 10-year, of course, that's going to be a little bit lower, although the yield curve is pretty flat right now. But let's just say, your 2-3% return. Well, would you take that, or would you take an 8% return, right? So we can look at stocks, right? Well, what's our average dividend on stocks on the S&P 500? Well, again, that's most likely going to be under the rate that you would get on long-term bonds. Well, let's just say that's around 2 or 3%. Well, what else? How about a bank account? Well, we all know what you're getting in a bank account right now, and that's basically zero. In fact, you're losing money in a bank account because the rate of inflation is higher than the interest rate that you're being paid in your bank account. So you are losing money. It's a guaranteed loss to keep your money in the bank right now. So when you compare real estate, at least the cash flow, the yield that you're getting on a nice solid rental property to other assets, there really is no comparison, especially when you look at your downside and when you look at the asymmetry that I always look for in an investment. That means very little downside and much more upside. You can't beat real estate. Let's move on. Number 4. And this is something that most people don't think about, but is extremely important. And that is that you have control. So you're not taking your money and you're not putting it into a stock where you've got to rely on the CEO. You've got to rely on all of the employees that work for that company, the brand. You've got to rely on their ability to access capital markets. And I could go on and on and on. But the bottom line is most of these things are out of your control. And I like to invest in things that I have control of because there's no greater custodian of my money than me. I know that, as Milton Friedman always used to say. So I want control of that asset. I think I'm going to do better when I have control than when someone else has control. And if you look at bonds, look at, my goodness gracious, look at who you're giving control of when you buy a bond. You're giving it to the United States government, and they're promised to pay you back in dollars that are worth the same amount as the dollars that they borrowed. And how is that consistent with their inflation target? Think about that for a second. You've got a government that you're lending money to that has stated publicly that it has an inflation target or decrease in the value of the dollars that they borrowed from you by at a minimum 2% per year. That makes absolutely no sense. So again, the takeaway for number 4 is real estate is a great investment, the best investment, because you have control over the asset, you have control over the investment. Now, number 5, last but not least, and this is kind of all encompassing. This is the broad net that we cast, but just in general, real estate is going to have a better ROI, whether it's cash flow, whether it's appreciation. If you compare it to other asset classes, it's really, really tough to debate that real estate is number 1. And when you look at these other asset classes, you don't have the ability to go in and make improvements. So you don't have the ability to add value. If you go into real estate, if you buy a property that's unloved in a really nice neighborhood, on a nice street, you buy it, you put in maybe some sweat equity, or maybe you have a general contractor go in there and remodel it. All of a sudden you have the ability to take 50 cents buy the property, take another 25 cents and do a remodel, and all of a sudden you have a property that's worth $1. You just built in equity. And that's something that you don't have the opportunity to do if you buy gold or if you buy a stock. On a similar note, real estate is you get great ROI because real estate is an efficient market. I wanted to say a very efficient market, but in the United States, it's a lot more efficient because of the MLS and many other things than in other countries where I like to invest, where it's extremely inefficient, the market. You can take advantage of those inefficiencies. But looking at, let's say, the currency market or looking at the stock market, you can't find arbitrage plays there. You can't buy a share of Apple on the West Coast and sell it on the East Coast for 10% more than you paid. The market is too efficient. You're always going to have buyers and you're always going to have sellers. The price that they quote, that's the price that you get. Or with real estate, it's much different. You can go in and you could find a seller that's in a distressed situation, and you might be able to offer them an out. You might be able to offer them liquidity. You might be able to find something that's off market, and you might be able to get it at a fraction of the price of what you could have got as a market rate if you would have been willing to hold on to that property for, let's say, 3 months, 6 months, a year, and actually get what the going rate is. So lots of inefficiencies that create massive opportunities for real estate investors and the ability to go ahead, rehab, remodel, create value or create additional value. And those opportunities just aren't there in other asset classes. So those are my 5 reasons. I'm going to review them one more time here. Number 1 is a hedge against inflation. Number 2 is the use of leverage. Number 3 is a higher yield on cash flow. Number 4 is you have control of the asset. And number 5, just in general, you get a better ROI. So those are my top 5 reasons for investing in real estate. Guys, if you are super excited about real estate investing, if you want to learn more about real estate investing, maybe you're a newbie, or maybe you're an intermediate or a professional that just wants to become better, go ahead and subscribe to this channel. I've got vlogs that come out. I've got educational videos. And then I also have the Macro Real Estate Investing Show, which takes a look at the macro environment most of the time in the United States and shows you how you can apply that to your real estate into your real estate investing to become better. So hit the subscribe button, hit the like button. If you have any questions, leave them in the comments and I'll do my very best to answer them. And we'll see you guys in the next video.